Have you ever bought a hot new IPO, only to watch it crash and burn while you're still holding the bag? Or maybe you sold too early, and then saw it skyrocket 300% without you. Here's the truth. Most traders lose money on IPOs because they don't understand the hidden life cycle that every big growth stock goes through. But once you do, you'll see exactly where to buy, when to hold, and how to cash out before the party's over. Today, I'm breaking down the top 10 lessons from the Lifecycle Trade, the playbook for turning IPO chaos into opportunity. Lesson 1 is simple but game-changing. Every stock has a life cycle, and once you know these stages, the chaos starts to make sense. It begins with the IPO advance phase, the birth of the stock. This is the wild, often volatile period right after listing, when the market is trying to figure out what the company is worth. You'll see big price swings, heavy volume, and plenty of emotional buying and selling. The next phase is the Institutional Accumulation Phase. This is where the stock begins to settle down. Big funds quietly start building positions, often over weeks or months, creating tight price action with more controlled pullbacks. This is the quiet before the storm, and often the best time to position yourself. From there, we move into the Climax Run, the growth spurt. Price accelerates, volume surges, and media attention goes through the roof. It's thrilling, but also dangerous, because this is often when the final buyers rush in just before the peak. After that comes the Post-Climax Decline, the aging phase. The big players take profits, momentum fades, and the stock can lose a massive percentage of its value. It's painful for those still holding, but predictable once you know the pattern. Recognizing these 4 stages is like having a GPS for trading IPOs. You know when to step on the gas and when to get off the road entirely. Lesson 2 is where most traders go wrong. They rush into an IPO on day 1, seduced by hype and headlines, but the big money rarely buys at the open. Instead, institutions wait for the chaos to cool, and then they quietly start building positions in what's called the Institutional Accumulation Phase. You'll see the stock trading in a tight range, with volume spikes on up days and gentle pullbacks on lighter volume. It's like watching a chess master set up a winning play, nothing flashy, but deadly effective. Enter here, and you're riding alongside the giants. Lesson 3 is about the first base, and why it's your golden ticket. The Lifecycle Trade's research shows the first base after an IPO has the highest potential for explosive upside. The stock is still fresh, the story is exciting, and there's minimal overhead supply. Picture Zoom in 2019. After its IPO, it formed a tight base, then exploded higher as institutions piled in. Waiting for that first base breakout can deliver a massive run with much lower risk than chasing day 1. Lesson 4 is the lie detector test volume. Price can move for all sorts of reasons, but volume reveals the truth. Heavy volume up days, institutions are buying. Heavy volume down days, they're selling. If you start seeing repeated heavy selling days near a peak, that's your early warning the party is ending. Beyond Meat in 2019 is a textbook example. Volume spiked dramatically both ways, and the shift in tone was obvious before the collapse. Lesson 5 is the most tempting and the most dangerous. The Climax Run. Gains accelerate dramatically. Headlines turn euphoric, and suddenly everyone you know wants in. The signs are clear if you look. Multiple gap-ups in a short period, parabolic price action, and daily ranges widening fast. Tesla in late 2020 was a masterclass in this pattern. Selling here feels wrong in the moment, but right when you look back. Scaling out into the strength of a climax means you keep your gains instead of giving them back. Lesson 6 is a reminder that patience beats chasing. Many IPOs go through a lockup expiration 90 to 180 days after listing, when insiders are finally allowed to sell. This can cause sharp drops or long consolidations. Seasoned traders treat it as a second chance to enter at better prices after weak hands are gone. Facebook in 2012 stumbled badly post-IPO, even dropping under $20, before quietly bottoming and starting a climb that made early believers rich. Lesson 7 is the harshest reality check. The post-climax decline is brutal. These aren't minor pullbacks, they can erase 70 to 90% of prior gains. GoPro, Fitbit, Tilray. All followed this script. Once the big money leaves, the stock often grinds lower for years. Averaging down here is throwing good money after bad. Survival means moving on to the next rising star, not clinging to the last one. Lesson 8 is about understanding that IPOs are a different species. They're more volatile, their swings are sharper, and their patterns are shorter and more unpredictable than mature stocks. If you trade them like blue chips, you'll get stopped out or blindsided by a drop. Adjust your position sizes, give stops more room, and be ready to act quickly. Trading IPOs is more like sprinting than running a marathon. You need different tactics. Lesson 9 is where this book really separates itself. The power of historical study. The authors didn't guess at these patterns. They studied hundreds of IPO charts across decades. They analyzed both legends like Nvidia, Shopify, and Google, and disasters like Webvan. This historical perspective proves that while technology changes, human behavior doesn't. Greed and fear leave the same fingerprints today as they did 20 years ago. Building your own chart library will train your eye to spot patterns before the crowd does. Lesson 10 is the glue that holds it all together. A system beats emotion. In the heat of the moment, your instincts will betray you, telling you to hold too long, chase too late, or sell too soon. The Lifecycle Trade lays out specific buy points, sell rules, and risk parameters so you don't have to think on the fly. Whether it's selling into a climax, cutting losses quickly, or waiting for the first base breakout, your plan keeps you steady while everyone else panics. And here's the bonus truth the book makes clear. This system gives you permission to do nothing when the odds aren't in your favor. You're not supposed to be in the market 24/7. You wait for those moments when probability tilts heavily in your direction. That's when trading stops being a stressful guessing game and starts becoming a disciplined business. You're not reacting to random price moves anymore. You're anticipating phases before they fully play out. And when you can execute with that kind of clarity, your confidence and your account balance grow together. If you've ever been burned by an IPO or missed out on a huge run, remember, it's not luck, it's pattern recognition. Respect the stages, follow the footprints of institutions, and above all, have a system. The Lifecycle Trade hands you the blueprint. Learn it, practice it, and the next time a promising IPO hits the market, you'll know exactly what to do. You won't be guessing, you'll be executing. And that's the difference between riding a 300% move and watching it happen from the sidelines. If this breakdown gave you clarity, hit like, subscribe, and let me know in the comments which of these lessons you're going to apply first. And if you want me to discuss any key concepts in more detail from this book, the ones you can literally copy onto your screen tomorrow, tell me, and I'll make that in a future video.